Financial Leverage and Capital Structure Policy. Chapter 16. Financial Leverage and Capital Structure Policy. Key Concepts and Skills. The capital structure question. Understand the impact of taxes and bankruptcy on capital structure choice. Capital structure and the cost of equity capital. Bankruptcy costs. Optimal capital structure. Financial leverage refers to the extent to which a firm relies on debt. The more debt financing a firm uses in its capital structure, the more financial leverage it employs. Capital restructuring. We are going to look at how changes in capital structure affect the value of the firm, all else equal. Capital restructuring involves changing the amount of leverage a firm has without changing the firm's assets. The firm can increase leverage by issuing debt and repurchasing outstanding shares. The firm can decrease leverage by issuing new shares and retiring outstanding debt. Choosing a capital structure. What is the primary goal of financial managers? Maximize stockholder wealth. We want to choose the capital structure that will maximize stockholder wealth. We can maximize stockholder wealth by maximizing the value of the firm or minimizing the WACC. The effect of leverage. How does leverage affect the EPS and ROE of a firm? When we increase the amount of debt financing, we increase the fixed interest expense. If we have a really good year, then we pay our fixed cost and we have more left over for our stockholders. If we have a really bad year, we still have to pay our fixed costs and we have less left over for our stockholders. Leverage amplifies the variation in both EPS and ROE. Example, financial leverage, EPS and ROE. What happens to EPS and ROE when we issue debt and buy back shares of stock? Current and proposed capital structures for the Trans Corporation. Proposed. Current. 80 lakh. Asset. 40 lakh. Debt. Equity. 1. Debt equity ratio. 20. Share price. 2 lakh. 4 lakh. Shares outstanding. 10%. Interest rate. Example, financial leverage, EPS and ROE. Current capital structure, no debt. Expansion. Expected. Recession. $1,500,000. $1 million. $500,000. EBIT. Interest. 15 lakh. 10 lakh. 5 lakh. Net income. 18.75%. 12.5%. 6.25%. ROE. 3.75. 2.5. $1.25. EPS. Proposed capital structure, debt equals $4 million. 4 lakh. 11 lakh. 6 lakh. 1 lakh. 27.50%. 15.00%. 2.5%. 5.5. 3. 50 cents. Example, financial leverage, EPS and ROE. Variability in ROE. Current, ROE ranges from 6.25% to 18.75%. Proposed, ROE ranges from 2.5% to 27.50%. Variability in EPS. Current, EPS ranges from $1.25 to $3.75. Proposed, EPS ranges from 50 cents to $5.50. The variability in both ROE and EPS increases when financial leverage is increased. Break-even EBIT. Find EBIT where EPS is the same under both the current and proposed capital structures. If we expect EBIT to be greater than the break-even point, then leverage may be beneficial to our stockholders. If we expect EBIT to be less than the break-even point, then leverage is detrimental to our stockholders. Capital structure theory. Modiani and Miller, M&M Theory of Capital Structure. Proposition I, Firm Value. Proposition 2, WACC. The value of the firm is determined by the cash flows to the firm and the risk of the assets. Changing firm value. Change the risk of the cash flows. Change the cash flows. Capital structure theory under 3 special cases. Case I, Assumptions. No corporate or personal taxes. No bankruptcy costs. Case 2, Assumptions. Corporate taxes, but no personal taxes. Case 3, Assumptions. Bankruptcy costs. Case I, Propositions 1 and 2. Proposition I. The value of the firm is not affected by changes in the capital structure. The cash flows of the firm do not change, therefore, value doesn't change. Proposition 2. The WACC of the firm is not affected by capital structure. Case I. Equations WACC equals RA equals E/V RA plus D/V ROD. RA equals RA plus RA dash ROD D/E. RA is the cost of the firm's business risk, i.e., the risk of the firm's assets. RA dash ROD D/E is the cost of the firm's financial risk, i.e., the additional return required by stockholders to compensate for the risk of leverage. Figure 16.3. Case I. Example data 1. What is the cost of equity and WACC? Required return on assets equals 12%, cost of debt equals 8%. 1. What is the cost of equity and WACC? RA equals 13%. WACC equals 12%. 2. What is the cost of equity and WACC? RA equals 16%. Business risk and financial risk. Systematic risk of the assets. A. Business risk. Level of leverage. DE. Financial risk. Case 2. Cash flow interest is tax deductible. Therefore, when a firm adds debt, it reduces taxes, all else equal. The reduction in taxes increases the cash flow of the firm. How should an increase in cash flows affect the value of the firm? Case 2. Example firm L. Firm U $1,000 EBITDA interest $920. Interest $920. Taxable income $276. 300. Taxes 30%. $644. $700. Net income. Firm L. Firm U. Cash flow from assets 1. U. EBIT 276. 300. Taxes $724. $700. Total. Firm L. Firm U. Cash flow 644. 700. To stockholders 80. To bondholders $724. $700. Total. Interest tax shield. Interest tax shield. The tax saving attained by a firm from interest expense. Annual interest tax shield. Tax rate times interest payment. Annual tax shield equals 0.3080 equals $24. Present value of annual interest tax shield. Assume perpetual debt for simplicity. PV equals 24.08 equals $300. PV equals TC times D times ROD. ROD equals TC times D equals 1000 times 0.30 equals $300. Figure 16.4. Case 2, Proposition I. The value of the firm increases by the present value of the annual interest tax shield. Value of a levered firm equals value of an unlevered firm plus PV of interest tax shield. VL equals VU plus TTC. Value of equity equals value of the firm, value of debt. assuming perpetual cash flows. VU equals EBIT 1T, RU. The static theory of capital structure. The theory that a firm borrows up to the point where the tax benefit from an extra dollar in debt is exactly equal to the cost that comes from the increased probability of financial distress. Case 3. Case 3 Capital structure, some managerial recommendations, taxes. Firms that have substantial tax shields from other sources, such as depreciation, will get less benefit from leverage. The higher the tax rate, the greater an incentive to borrow. Financial distress. Firms with a greater risk of experiencing financial distress will borrow less than firms with a lower risk of financial distress, EBIT. Financial distress costs will be determined by how easily ownership of those assets can be transferred, tangible. The pecking order theory. Firms prefer to use internal financing whenever possible. Bankruptcy costs, direct costs, financial distress. Legal and administrative costs ultimately cause bondholders to incur additional losses. Disincentive to debt financing. Financial distress. Significant problems in meeting debt obligations. Firms that experience financial distress do not necessarily file for bankruptcy. More bankruptcy costs, indirect bankruptcy costs. Larger than direct costs, but more difficult to measure and estimate. Stockholders want to avoid a formal bankruptcy filing. Bondholders want to keep existing assets intact so they can at least receive that money. Assets lose value as management spends time worrying about avoiding bankruptcy instead of running the business. The firm may also lose sales, experience interrupted operations, and lose valuable employees.